Welcome to the Level 1 Financial Reporting and Analysis Summary video series. This video is a summary of the reading on financial reporting mechanics. This reading is essentially an executive summary of accounting, or the accounting that you as a financial analyst need to know. The first part is recognizing the accounting elements. We have assets, liabilities, owner's equity, revenues, and expenses. And then these are the accounting equations that you must know. Assets equal liability plus equity. And then recognize that equity is contributed capital, which is the money that has been contributed by the shareholders, plus retained earnings, which is money the company generates that could be given to shareholders but is retained within the company. The earnings during a given period are also called net income. These are revenue minus expenses. When you put this information together, you get a more detailed accounting equation, which is shown here. Assets equals liability plus contributed capital plus beginning retained earnings plus revenue minus expenses. That's the net income. And then from that, you pay out the dividends. Here, I'm just giving you a quick summary. You can easily get questions that allow you to use the relationships shown over here. Next is the accounting process, and we are going to come up with a few simple accounting entries. You don't need to use credits and debits. All you need to say is which account is going up and which account is going down, or what are the two accounts that are impacted. So if somebody starts a business and he capitalizes or starts the business with a deposit of 600, and then all these other transactions happen, I want you to spend 2 minutes and quickly write down the accounting transactions just to make sure you get this right. So this is what you should get. For the first one, cash goes up by 600, contributed capital up by 600. Then if he borrows 400, gets cash. So cash, which is an asset, up by 400. Debt, which is a liability, up by 400. Buying inventory, cash down and inventory up. And then this is the slightly tricky one, sell inventory for 700. So inventory goes down and expense, which is an equity account, also goes down. So your balance sheet remains balanced. And then at the same time, we receive cash 700, so that goes up, and revenue goes up by 700. The net impact of the revenue item and the expense item is that we are up by 200. All right, next slide. Accruals and valuation adjustments. Accrual accounting requires that revenue be recorded when earned and expenses be recorded when incurred, irrespective of when related cash movements occur. There can be two broad scenarios. Either the cash movement can happen prior to accounting recognition or after. If the cash movement happens prior, then these are the scenarios. You can have unearned revenue, which means that the money has been received, but the product or service has not been delivered. So the cash goes up, and cash is obviously an asset. The liability item is unearned revenue, that also goes up. It's a liability because there is an obligation to perform the service or deliver the product. Then once the product or service has been delivered, then the unearned revenue, which is a liability, comes down, and the revenue, which is an equity item, goes up. So notice always the two transactions will be such that the balance sheet remains in balance. Prepaid expenses. Here a company might pay for rent for the next period. We record cash because obviously cash is going down, and we create an asset called prepaid expense that goes up. Adjusting entry is when, let's say, the facility is used. So the prepaid expense, which is an asset, comes down, and the expense is recognized, so equity also comes down. On the other side, we have cash movements after account recognition. The classic is unbilled or accrued revenue. This is a receivable where we have sold or delivered a service but not received money. As long as we are sure we will receive money, and this will connect with revenue recognition that we'll talk about very soon. So we record revenue, which is equity, and we create a receivable, which is an asset. The adjusting entry when we receive the cash is to reduce AR and to record cash. So one asset goes up and one asset goes down. Accrued expense, this is where we accrue an expense, such as we might have employees working for us during a month, but we don't pay them. So we show the expense and create a liability called salaries payable in my simple example. Then when we pay the salaries, we reduce the liability and record the payment, which means we reduce cash. This slide deals with accounting systems. So just very briefly, the first step is to create journal entries where the business transactions are recorded chronologically. From this, we create a general ledger where the business transactions are sorted by account. Then we create a trial balance where account balances at a particular point in time are recorded. So you'll say cash on 31st December is this, inventory on 31st December is so and so. Then any adjustments to that are made and we have the adjusted trial balance, and it is the adjusted trial balance which is then used to create the financial statements. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.